Hello students, welcome to my channel again. Today we are going to talk about the financial assets valuation. What is financial assets and how do we evaluate those assets? So first of all, let's start from its basic concepts. What is financial assets? Before that, I want to clarify some basic understanding of financial management. The basic objectives of organization is to maximize shareholders' wealth, which can be accomplished by maximizing value of assets, example bonds, stock, etc. So, financial assets valuation explains the relationships of value of such assets with time horizon and market interest rate. What is real assets and financial assets? The real assets is the assets that are in physical form, that we can see, we can touch them physically. For example, land, building, machinery, and gold and silver. And the financial form, some of the assets are in financial form. For example, assets that don't physically exist is known as financial forms assets. For example, a treasury bill, bond, stock, debenture, and certificate of deposits. The features of financial assets: no physical existence. So financial assets does not have got the physical existence like real assets. So it doesn't have the physical existence. Number two, more liquid. It is more liquid, or we can easily sell it. We can easily generate the cash out of the assets, unlike the real assets. Third, don't have own productive capacity. It doesn't produce its own anything. Fourth, easy to mobility. It's very easy to move from point A to V is equal to CF1 1 plus K 1 CF2 1 plus K 2. In this way, CF1 divided by N, where CFN is equal to expected cash flow at time t. K is equal to investor required rate of return T is equal to time period and N is equal to time to maturity. To further clarify, let's have a look at another example. The example is, assume that an asset is expected to generate rupees 50,000 each year for next 4 years. If the required rate of return is 10%, what should be the value of these investment opportunities? So we know that the cash flow is CF is 50,000 for next year, for next 4 year. So number of year is 4 year. The required rate of return is 10%. It is asking value. Let's put all of this figure in this formula, whereas V is equal to CF1 cash flow 1 means cash flow in first year is 50,000 and 1 K is interest rate or required rate of return is 10% power 1. So for the coming 4 year the cash flow is same, which is 50,000 1 plus 0 1 3, and lastly 50,000 divided by 1 plus 0.1 4. Let's do some calculation here. 1.1 power is equal to 50,000 1.1 power square, 50,000 1 plus 1 power 3 plus 50,000 1 plus 1 power 4. 45,454.55 plus 41,321 plus 37,565.74 plus 34,150.67. So altogether its final valuation is 1,58,493.27. Students, now let's have a look in depth into the financial assets. The very famous financial assets is bond. Bond is one of the popular debt capital investment of the long-term financial. So what are its features? So let's have a look its features. Par value. Bond is generally issued at par value of 1,000 in most of the currency. And coupon interest rate. Coupon interest rate is the payment is known as the coupon interest rate. So the interest payment that we made through the bond is called interest, like in our bank's saving account. Maturity. Generally, bonds are issued with finite maturity date. What is maturity date? Maturity date is the date on which the principal amount or par value is repaid. Fourth, indenture. Indenture is the legal document or the contract that contains terms and conditions of the bond issue. Fifth, call provision. What is call provision? Call provision is the provision of right to given to the issuer to call the bond before the maturity date. Trustee. Trustee is a representative of the bondholder who deals with the issue relating to the company. And finally, sinking fund. Sinking fund is a special provision in a contract that facilitates the orderly retirement of the bonds. These are the basic features of bond. Now let's have a look the cash flow of the bond and how do we manage those cash flows. Value of bond is equal to present value of coupon interest rate plus present value of maturity value. Let's further clarify this one. Value of bond is equal to I1, I in first year, 1 plus K 1 plus coupon interest rate in year 2, 1 plus interest rate year 2. In this way, I number n plus K square number of n. where I is equal to coupon interest rate, KD is equal to the appropriate discount rate, and N is equal to maturity period in year, and finally M is equal to maturity value or par value. There are several types of bond depending upon their nature and their features. The very first one is the perpetual bond. What is perpetual bond? A bond issued without finite maturity period is called perpetual bond. It promises to pay the interest indefinitely. I have previously mentioned that it has a maturity date, but in the perpetual bonds it doesn't have any maturity date. It will pay the coupon interest rate in finite number of years. So PD is equal to interest rate 1 plus KD required rate of return 1 plus I plus KD 2 plus this time interest rate is given and the rate of interest is KD, the power is the infinite power, or T is equal to 1 plus KD is infinite, or in simplified the valuation is simply interest rate divided by required rate of return. So let's have a look at the simple example here. The example here is a firm has issued $1,000 per bond with 10% coupon interest rate. The required rate of return is 12%. What is the value of bond? So in this way, in this question, we should not confuse with the required rate of return and the coupon interest rate. So the interest rate, the coupon interest rate we get is the 10% of 1,000 because coupon. So let's solve this. Coupon interest rate is, so we have a formula here, I divided by KD. We do here interest rate is 10% divided by required rate of return is 12%. In this way, the 10% of 1,000 is 100, and divided by 0.12, we get the value of rupees 833.33. Zero coupon bond. What is zero coupon bond? By its own name, the bond that does not pay any interest rate. So it doesn't have any interest rate. It only have the maturity date. VD is equal to 0, 1 plus KD 1, 0, 1 plus KD 2 plus at the end of the maturity date, its par value divided by KD number of n. So this is 0 plus 0, we only get thus we have the formula is 1 plus required rate of return power. The question is, suppose XYZ company has recently issued a pound 1000 par value bond, 5-year 0 coupon bond, and bondholders required rate of interest rate is 10%. What is the value of bond? So we know the formula here. The simplified formula is value of bond is M over KD power n. M is the par value of bond, which is 1001. Required rate of return is 10%. The bondholders required rate of return is 10%, and number of year is, we know that, 5 year. So we solve here 1000 1.1 power n, so we get answer 620.93. Now let's have a look at another kind of bond, the very famous VD is I1 1 plus KD, I2 1 plus KD, plus I number 1 plus KD number plus the par value of bond and KD power n, or in short, and summation T is equal to 1 IT 1 plus KD power n power T plus maturity 1 plus KD power n. We can calculate the valuation of this kind of bond is I multiply by 1 minus 1 over K plus KD and divide by the rate of return plus M 1 plus KD power n. So we know that, or in simple way, valuation of bond is I multiply by present value interest factor annuity, required rate of return and number of year, plus M multiply by present value interest factor, KD and N. Suppose Himalayan Construction has just issued 12% coupon interest rate bond at $1,000 par value. It has 15 years to maturity and required rate of return is 15%. What is the value of bond? So let's simply use this formula here. Value of bond is rate of interest is the coupon interest rate is 12% of $1,000, and present value interest factor annuity required rate of return is, we know that, 15%. Then number of year is 15 years, plus what is M? M is the par value of bond, which is $1,000, and present value interest factor, not annuity, only in only present factor, 15%, no, and 15 years. We know that the 12% of 1,000 is 120. The present value interest factor annuity 15% and 15 years is $10.5631 plus $1,000 multiplied by the interest factor is 0.5775. So in this way, if you multiply 120 by 10.5631, we get 448.3993 plus 577.50. So altogether the value of bond is $1,026.43. Sometimes the bonds can be issued in discount rate or at a premium rate. So what is the bond when we issue the discount rate? A bond is issued to the discount rate when it is currently selling at the below the price, below the par value. What is premium bond? A bond currently selling above its par value, it's called as the premium bond. So there is a specific relationship between market return or market or required return and the coupon interest, coupon return. There is three conditions. The one is if coupon rate is more than market interest rate, it is selling at premium. Second, if the coupon interest rate is below the market rate, then the bond is selling at discount rate. And thirdly, if the coupon interest rate is exactly equal to the market interest rate, then bond is selling at the par value. To further clarify this concept, let's have a look at the questions here. ABC company just issued 8% coupon interest rate bond having the 10 years maturity, and the face value is pound 1,000. What is the value of bond on the following maturity, following interest rate? Mostly is 10%. It has both maturity and it has coupon interest rate. So we can use this formula. I multiply by present value interest factor annuity, required rate of return and years, plus face value multiplied by present value interest factor, cost of required rate of return and number of year. So what is the coupon interest rate? The coupon interest rate is 8% of 1,000, which is 8% of 1,000, and present value in interest factor annuity is, we are looking at exactly 8%. The number of year is 10 year, and the face value is 1,000 pound. Then present value interest factor, we are looking at 8% in 10 year. So the coupon interest rate is 8% of 8,000 is 80, and the present value interest factor annuity at 8% for 10 years is 6.7101 plus 1,000 multiplied by the interest factor rate is 0.4 632. So the altogether it is pound 1000. So exactly 1000. So the value of bond is 1000 because the rate of return, the coupon interest rate is 8% and the required rate of return or market rate is 8%. So this is the last condition, that if the coupon interest rate is equal to the market interest rate, then the bond is selling at par value. Now let's have a look what happens if the required rate of rate or market return is 10%. We know that we can use this formula. Again, present value interest factor annuity, cost of required rate is 10%, number of year is 10 years, plus present value interest factor, required rate of rate is 10% at 10 years. So coupon interest rate, as we already know, it's 80 quid, and present value interest factor at 10% in 10 years. If you look on the financial table, it's the 6.1446 plus face value is 1000 pound, and factor we find out here is 0.3855. So altogether it is rupees 7.6. So the value of bond is below the face value because coupon interest rate is less than market interest rate. That's why we are forced to sell our bond at the discounted rate price. Thirdly, let's have a look. What about if the required rate of return is 6%? Again, interest rate, present value interest factor annuity, required rate of return is 6%, maturity years is 10 years, plus face value is 1000, then present value interest factor, required rate of return again 6%, and maturity date is 10 years. Coupon interest rate is, we already know, 80 pound. The factor rate is 7.3601 plus 1000 multiplied by 0.5584. So final value is 1147.21. Value of bond is more than its par value because if the coupon interest rate is more than market value, the coupon interest rate here is 8% and the required rate of return is only 6%. So coupon interest rate is more than the market interest rate and we are selling our bond at premium. Now simply let's make a table for this. Required rate of return, bond value, and status. It is 8%. The bond value is, we know that. What is the bond value? Exactly 1000. Selling at par. When the value of bond is 10%, the value of bond is 877.6, selling at discount. Then the required rate of return is 6%, then we are selling at 1147.21 at premium. So let's make a graphical representation for this. The y-axis and x-axis. Y-axis is the value of bond and x-axis is the required rate of return. Required of return is 2%, 4%, 6%, 8%, 10% and 12%. 700, 800 pound, 900 pound, 1000 pound, 1100 pound, 1200 pound and 1300 pound. At 8%, the value of bond is the 1000, which is over here, and at 10%, the value of bond is 877, so around here, and at 6%, the value of bond is 1147, so 1100 here, so up around 6%. What is 6%? 6% is here, so over here. So if we add all of this point, this looks like this. There are several kind of risks in bond. The first one is the interest rate risks. What is interest rate risks? Interest rate risks that arise for the bond owner from the fluctuating interest rates in the financial markets. The longer the maturity of the bond, the more its price will respond to a given change in the interest rate. Let's have a look in one example here. There are two bonds, bond L, which has a longer maturity time, and bond S, who has shorter. The long bond has 15 years of maturity date, and short has got the 3 years of maturity date. Both have got 6% coupon interest rate. 2% of required returns, 4% required of return, 6%, 8% and 10%. In 2% required of return for bond L, you get 15.14, and for bond S, 1115. This will be trading as a premium. And for the 4%, if you calculate, you will get 122 for longer bond and 1056 for shorter one. Both are selling in premium. For 6%, both will get 1000. So for the 8%, for longer one 829, shorter would be 948, which is below its par value, so it would be selling at discount. And for the 10% again, we calculate, the value will be 696. For the shorter one would be 901. Both are below face value, so both will be traded in discount. The y-axis is value of bond, and x-axis will be the required rate of return. This is 0, 2, 4, 6, 8, 10, 6, 8, 1000, 12, 14. So if you just plot this, so this is 1000 par value and 6% here. So this is our both bond, 6% for 1000, and for the 2%, the longer bond is valued as 1500, which is around here. For 4%, it is 1200, 22. For 4% is 22 over here, and 6%, we have already done this one. For the 8%, the value is 289. 8% is around here, and for the 10%, the value is 69, around here. let's add all of these graph, this point. This is for long-term bond L. Short-term one is for the 2%, it's 11 around here, 1100, and for the 4% it's 1056, slightly over here. What is over here? Then for the 6% we already got this one, 1000, and for 8% is 498, so around here, nearly 8% is here, it's around here, 10% 901. So let's plot this graph here with this short-term bond. The point between the long-term bond is really slope. That means it is risky. The short-term bond curve is quite flat, so that means it is less risky. Change in the bond value over the time. So what happens for the longer period of bond and the short period of bond? In this concept, it is known as that when the required rate of return is different from the coupon interest rate and remains constant until the maturity, the value of bond will approach its par value at the end. Required rate of interest is 9%, at 12%, then 14%. So if you calculate yourself, you will get the value in 15 years of is 12423 for 9%. For the 12% you will get 1000 exactly. Then for the 14% you will get 877. For the 10 years 9% required return, you will get the value of 1192.2. For 12% you will get 1000 in 10 years. Then 14% you will get 895.9. Lastly, for the 5-year maturity, the 9% 1116.5. For the 12% you will get 1000. Then for the 14% at the 5-year you will get 931. $800, 900, 1000, 1100, 1200. What is the maximum? And 1300. So let's plot the graph. For the 9%, this is 5%, 10%, and this is 15%. The par value is 1000 in 12%. So this is 1000 in 12%. You will get 10, 11, 12. So around here you will get your par value. This point here, this point you will get the par value 12%. For the 9%, this is 877 and its value is going up slightly like this. For the 14%, the value 142 from here, and this decreases down to the slightly decreases down here, like here, premium value bond and discount value bond, and this is par value bond. Bond yield refers to the different measures of bond return. So the first method to measure the bond return is rate of return. So what is rate of return? Rate of return, also called holding period returns, the total return can be calculated as coupon payments plus capital gain or loss and divided by investment. The rate of return, coupon payment plus ending price minus beginning price divided by. Suppose you buy a 10% treasury bond today for a price of pound 120 and sell it next year at a price of rupees 1050. What is the rate of return on your investment? So simply just use this formula, then we can find out the rate of return like this. We know that the coupon payment is 10%, so face value is plus the ending price is the bond was sold in 150 pound, 150, and the beginning price of the bond was pound 1020, and the investment was, the beginning investment was 1020. So we get 10% of 1000 is 100 pound plus 150 minus 120 plus 30 divided by 1020, 0.1275, that is 12.75% of current yield and capital gain yield. What is current yield? Current yield, it only measures the partial indications of bond return. That means investors who do not consider to hold bond until the maturity. Current yield is equal to coupon interest rate divided by current market price of bond. Current market price of bond. Capital gain yield is ending price minus beginning price divided by beginning price. Suppose ABC company is currently selling a bond for $900. Coupon rate is 10%, and the expected year in price is $945. 10% of 1000 divided by the price of bond was $900. So that means $100 divided by $900. Then we get 0.1111. That is 11.11%. Let's calculate the capital gain yield. Capital gain yield is simply, we know that the ending price is $945, and the beginning price is 900 divided by the beginning price, which is again 900. So simply we get here $45 divided by $900, we get 0.05, that is 5%. Now let's have a look at another method. The method is called yield to maturity, or YTM. What is YTM? Under the YTM method, there are some assumptions. The first assumption is the bond will be held until maturity. You can't call out before maturity of the bond. In second number, coupon interest rate and principal will occur as mentioned in indenture. That's the second. And in the third, the bond will not be called out before maturity at all. And fourth, coupon interest receipts will be reinvested at a rate of return equal to the YTM. So there is a specific formula to calculate the value of this under this method. First of all, we have to calculate the approximate return. The formula is approximate YTM is equal to I is equal coupon interest rate market price and divide by plus 2 price whole divided by 3. After this, we need to find out the value of bond, which is 1 minus 1 KD power n divided by KD plus m 1 plus KD power n. Basically, it is simply present value interest factor annuity, interest multiplied by PBIFA in a given required rate of return, number of year, plus present value interest factor and face value multiplied by present value interest factor, not annuity, only interest factor, and required rate of return and number of year. One example here. Suppose Lotus Software has 10% coupon bond on the market with 10 years to maturity. The bond makes annual payment and currently sell 90% of the par value. What is the YTM on this bond? So first of all, we have to calculate the approximate YTM. We are given here, the formula is I is rate of interest, which is 10% is coupon interest. So 10% of 1000 is 100, plus M is the face value is obviously 1000, and the price is 900. Number of year is 10 year, divide by M is face value again 1000 plus 2, price is 900, divide by 3. So let's do some, and 1000 plus 9 to 2 18 divided by 3, 100 plus 10, we get 1900 divided by 3. In this way we get the value around 0.1179, which is 11.79%. This is our approximate YTM. So we need to find out the actual YTM. How do we find out the actual YTM? This 11.79% lies between 11 to 12%. So let's calculate. Let's have a look in 11%. What is the value of bond? So we will use this one for simple for simplicity. So I multiply by present value interest factor annuity KD n plus M present value interest factor annuity KD and N. So we know that interest rate is, the coupon interest rate is 10%, so it's obviously 100 plus present value interest factor annuity, required rate of return is 11%, then number of year is 10 year, and face value is 1000, PVIFA present value interest factor, not annuity, only interest factor, in 10%, no 11% and 10 year, 100 plus, if you look on the table we get the value 5.8892 and 1000 multiplied by, if you look the PVIF table, 11% and 10 years, 0.3220. This way we get the value of 941. Now let's try 12%. This is the 941 is more than 900, so this can be our this cannot be our rate of return. So let's try 12%. Again, let's put interest rate is 100 multiplied by present value interest factor annuity. This time we are using cost of debt or required return is 12% and 11 year, plus face value is 1000 multiplied by present value interest factor. We are looking 12% and 10 years. We get 100 multiplied by the value, which is 5.6502 plus 1000 multiplied by 0.3220. In this way we get $887, which is less than $900. By interpolation, YTM is equal to, we have got formula here, we know that you need to recall lower rate plus present value at lower rate minus present value exact figure, present value lower rate minus present value higher rate multiply by higher rate minus lower rate. So let's put, we know that lower rate is in between 11 and 12. 11% is the lower rate plus present value at lower rate, which is 11%. We got 941 minus the present value at the exact is 900, then present value at lower rate again 941, and present value at higher rate is, we just calculate 12%, which is 887. Then higher rate is 12%, lower rate is 11%. So if you calculate, you will get the figure of 11.76%. So this is our actual. Our approximate YTM was 11.79, but our actual rate of required rate of return is 11.76. Stock. Common stock is a security issued by a company to raise equity capital. It is major source of long-term capital for company or firm. Common stock represents the ownership of the company. So the common stockholder, they are the real owner of the company as well. Common shareholder of a company are its real owners, and their liability is limited to the amount of their investment. Finally, the company finances the fund issued by common stock to purchase the company's fixed assets like plant and machineries, building and land, and other various fixed assets. There are some characteristics of common stocks. The first one is the par value. Same like the bond, it is also issued at par value. It have got face value or par value. Different countries, different organizations have got different par value amount. Maturity, it does not have any maturity date like bond, so it is forever lives. Third, voting rights. If you buy the common stock of any company, you have the voting rights, but for the debenture holder or debenture buyer, they don't have any voting rights. Also, in fourth number, it is primitive rights. What is primitive right? Primitive right is the existing right. Suppose company issued additional share in between the financial year, so the existing shareholder has got the primitive rights to buy, so they will get the first priority to buy the additional shares. Fifth, limited liability. Although they are the owner of the company, in case of liquidations, they are only liable to the amount they invested. Last one, the classified common stock. What is classified common stock? Some company might classify the common stock as stock A and stock B. For example, for stock A kind of common stock, they may not be voting right, but there shouldn't be any limited to the dividend payment policy. Similarly, in stock B kind of common stock, there may not be voting rights, but there may not be any limitation to the dividend policy. Common stock valuation. Of share. How do you calculate the insurance value of share? P of 0 is equal to D1 divided by 1 plus KD 1 plus D2 1 plus KD power 2 plus D infinitive 1 plus KD power infinitive. In this way, infinitive summation t is equal to 1 is the D1 1 plus KD power T, where P0 is equal to intrinsic value per share of common stock then D1 is equal to dividend per share expected at the end of the year then KD is equal to investor required returns. Investors required rate of return. What is dividend discount model? In the principle, valuations of common stock is more difficult than other financial assets because the expected cash flow of common stock is more uncertain as compared to others. Common stock dividends are expected to grow over the time period and the rate of growth may vary. And lastly, the life of common stock is infinite, so there is no maturity date. For infinite holding periods, there are three methods. The first method is zero constant rate, zero growth rate method. What is zero growth rate methods? That is, dividend per share is expected to be constant forever. That means dividend in year 1, dividend in year 2, 3, 4, it is expected to be at the same value forever. So P0 is equal to infinite summation t is equal to 1 d1 1 plus dt 1 plus ks power t, finally dividend divided by ks, that means the required rate of returns. To further clarify, let's have a look one question here. Assume that dividend per share of JP Morgan assumed to be £30 for indefinitely. If required rate of return is 15%, what is the intrinsic value of share? So given here, growth rate is 5%, and we are given here expected return is 15%. Then the dividend is £30 forever. So what is the value of share? P0 is equal to D divided by simply KS. We know that dividend is £30 and the required rate of return is 15%. In this way, we get share is £200. Another method is constant or normal growth model. What is constant normal growth model? This model assumes that the growth of dividend is growing forever at a constant rate and it is less than required rate of return. So the formula is D1 divided by KS minus growth. This is our formula. Let's have a look another example here. HSBC Bank common stock paid a dividend of $10 per share last year. That is expected to grow 5% forever. If investor required rate of return is 12%, determine the value of common stock. So we are given here D0 is equal to $10. The growth rate is equal to 5%. Then required rate of return is 12%. It's asking us value of share what is. So we know that the value of share P0 is equal to D1 divided by KS minus G. So D1, how do we calculate? We calculate D0 1 plus growth divided by KS growth. So D0 is equal to $10 and 1 plus growth rate is 5%. Then required rate of return is 12% and growth rate is minus 0.5. $150 under the constant normal growth model. So what is its assumption is that the dividend of the company may not grow at the same rate and the growth rate don't hold for a longer period of time. So the value of non-constant growth stock is equal to the present value of expected annual dividend during period of non-constant growth plus present value of expected stock price at the end of the non-constant growth period. So let's have a look. P0 is equal to D1 1 plus cost of stock 1 plus D2 1 plus cost of stock power 2 plus Dn k plus cost of stock power n plus Pn divided by 1 plus Kn. Let's take one example here. Assume lowest TSB paid dividend £20 per share last year, and dividend is expected to grow at 10% for 3 years and then at 5% rate indefinitely. Investor required rate of return is 12%. What is the price of share today? So for each year, during non-constant growth period, that means D1 is equal to D0 1 plus growth power T. Given here, growth rate is 10% for 3 years, then G2 is 5% for indefinitely, D0 is equal to £20, then required rate of return is 12%. So let's calculate D1. D0 is £20, 1 plus growth rate for year 1 is 10%. Number here is 1, so £20 multiplied by 1.1 power 1. That means we get value £22. Let's calculate D2. Again we calculate D0 1 plus growth rate power 2 year 2, that is D0 is obviously £20, 1 plus growth rate is 10% power 2, so we get value here 24.2. And lastly D3 is D0 1 plus growth power n power 20 plus 1/1 power 3, then we get value here 26.2. Step 2, at the end of non-constant growth period, constant growth period at the end of the 3 years is D3 plus D3 multiplied by 1 plus growth, new growth rate, growth C constant, divided by KS GC. That means we know that D3 is 26.2. Growth constants, that means after 3 years the constant growth rate would be 5%. Then required rate of return is 12% and growth rate is 5%. Pound 399.3. Step 4. Compute the present value of P3. PV of P3 we calculate by P3 divided by 1 plus K KS3. P3 is, we just calculated here, 399.3. Required rate of return is 12%, 284.2. Step 3. Compute present value of dividend. PV of dividend is equal to D1 1 plus K KS 1 plus D2 1 plus KS power 2 plus D3 1 plus KS power 3. We know that D1 is pound 22 divided by 1 plus KS is 12% power n plus D2 is pound 24.2 divided by 1 plus 0.12 power 2 plus D3 is 26.2 divided by 1 plus 0.12 power 3. In this way we get value is pound 57.88. So step 5, add present value of dividend plus horizon value of to compute intrinsic value of stock. So present value of dividend we just calculated earlier in step 3 is PV of dividend plus PV of stock. PV of dividend is 57.88 plus PV of stock is 284.2. So in this way the final value of stock would be pound 342.08. Year 1 to 3 DT in pound, present value at the rate 12% and present values. So DT is in year 1 we calculated 21.1 which is 22 and 20 and 22 multiplied by 1.1 is equal to 24.2, and in year 3 24.2 multiplied by 1.1 is equal to 26.62, and present value interest factor is 12% in year 1 is 0.8229, and year 2 is 0.79. 0.72 and year 3 is 0.7118. If you multiply 22 by this one, you get 19.64, and year 2 you get 19.29, and year 3 you get 18.85. So the PV of dividend would be 57.88. PV of P3 is equal to D3 1 plus GC divided by KS minus GC multiplied by present value interest factor KNN 3 years. We get D3 is 26.62. 1 plus growth rate is 0.05 after that, then 0.12 minus 0.05 multiply by in year 3 we get 0.7118. we would get the value as pound 284.21. so the finally value of stock at present would be present value of dividend 57.88 plus present value of stock is 284.21 is equal to ultimately pound 342.09. What is preferred stock? It is also known as preference share, and in the event of liquidations, shareholder claims on assets comes after creditors but before common stocks. However, non-payment of preferred stock dividend doesn't force into the bankruptcy. Characteristics. The very first characteristic is par value. It is also issued on par value, as we have already seen the bond. They are also issued par value. Fixed dividend. Dividend is fixed. For example, I just said 5% common stock or 10%. So that is the rate of dividend that preference share pays. Maturity. It can be issued both having maturity and without the maturity date. Cumulative features. What is cumulative features? Unpaid dividends are carried forward into the next year. So for various reasons, if the dividend isn't paid in current year, those unpaid dividend will be paid or carried forward next year. That's what the cumulative features means. Another very important point is voting rights. There is no voting rights for preference shareholder. Call features. Yes, it can be expired or called before its maturity. And lastly, adjustable rate and payment in kind preferred stock. So that means the rate, the dividend rate can be adjustable depending upon the circumstances. The example is Barclays PLC is considering raising fund with a preferred stock issue. It will pay 14% dividend and £100 par value. The preferred stock matures in 15 years. Investor required rate of return is 15%. Solution we are given here. Face value or par value M is equal to 100. DPS is equal dividend DPS is 14% and KPS is equal to 15%, and number of maturity year is equal to 15 years. Let's apply the direct formula here. The formula is DPS multiplied by present value interest factor annuity, cost of debt, number of year, plus present value interest factor cost of debt and multiply by face value 14. Present value interest factor annuity, cost of debt is 15% and number of year is 15 years. We know the face value is £100. Multiply by present value interest factor 15% in 15 years. If you look on the financial table, we get the PBIFA value of 5.8474 plus 100 multiplied by 0.1229. If you multiply by 14 by 5.8, you get 81.86 plus 12.29. The final value you get